I'm presuming I can be heard out there. So with that, let's move forward. Welcome to the May Monthly Market Monitor. And as we're pulling this together, I know Sister Virginia is smiling up in heaven somewhere. I pulled a 4-word alliterative title out of my pack of goodies. So we'll put that into our feather cap of something well done. Today, we're going to be talking about a couple of different things. I'm Kevin Chiappetta speaking. I'm going to speak a little bit about some current market activity, some things that are happening in the interest rate markets. We're going to be following up with Danny McIntyre, who's going to speak a little bit on the markets and values in the markets. But before we get that, there's some things that are going on right now in the marketplace. Some of you may have seen it. There's plenty to be said for how that's happening, what's happening in the world today. And we're going to get to focus on inflation. But before we do that, we are going to be speaking on markets later on in specific securities. As such, these disclaimers need to be in front of everybody. Somewhere in here is the right to sue Danny if he says anything wrong. So keep that in mind. Let's talk about inflation. Inflation comes in a number of different flavors. The chart that we're looking at today, right in front of us today, select commodity prices, and we're going to focus in on a little bit on particular commodities later on. But what this is telling us, there clearly is a trend. If we look to the right-hand side, this is year-over-year numbers, and you can see, pick your favorite commodity, whether we're looking at fuel, metals, the overall commodity price index, which is the yellow line, food prices, agricultural prices, whatever you want to look at. Since the beginning of May 20 through where we are now, May 2021, we are on a definite upward trajectory in commodity prices. So what we're feeling right now is what we would anticipate feeling as we're coming out of a slowdown, as people are starting to put money back to work, as coming out of hibernation. We're seeing just about every measure that you can look at when it comes to prices going up over the last year. What is interesting, however, the Bureau of Labor Statistics puts out the unemployment rate. For those of you who are paying attention Friday morning, that number came out with great disappointment. We were anticipating a significant number of new jobs coming through. That just didn't happen. What we're looking at here is the straight unemployment rate, the shaded area being a recession. And you can see what happens, that unemployment typically pops up during that recession. We saw a straight line up. Obviously, pandemics doing their thing, putting a lot of people out of work. That unemployment rate started to creep down, but we're not seeing it come back down to its pre-pandemic levels just yet. And in fact, the meteoric spike has not had a retracing coming backwards. We seem to be stalling out on the unemployment side. At the same time, from the same BLS, so we're talking about the same adjustments, et cetera. At the same time that unemployment is stalling out, job openings are spiking. So businesses are coming back online. Anything from restaurants, manufacturing, other things that may have slowed down somewhat. Areas that need workers, the job openings continue to come up while the unemployment rate is somewhat suffering. Now, without getting too opinionated, it's a rational decision for people to make when they get paid as much, if not more, to not work as to work. So we have some conflicting responses to the pandemic that are starting to express themselves at this point, where the people taking jobs are slowing down, job openings continue to move up. We're trying to get the economy moving, but we've got some friction in getting the people back to work. Certain states are starting to address some of this, others are not. We're going to get into a great debate as to who's responsible for what. We can stay away from that, but we know we have a general response, which we would anticipate being a value judgment made by a number of people to stay home and stay out of the workforce. So we've got a little bit of a conflicting signal there. If we want to look at unemployment in a slightly different way, a lot of times we start to check and see, who is unemployed. You can be not working and still not be unemployed based on some of the way that number is measured. But if we look at the number of employed to population ratio, look again, we had that big spike down, which we would anticipate towards early 2021, and we had a rebound, but the rebound isn't retracing either. So if we want to dismiss away some of the unemployment numbers as saying, that's we've got people retiring, got people coming out of the workforce, albeit true, but still a little bit more of the raw employment number here. This employment to population ratio is showing us that we do in fact have a number of people on the sidelines that we need to get back into the employment situations where they can start to contribute and start to contribute to a growing economy. A couple of other things that are happening in the world that are affecting price levels. Here's a measure of sort of, we'll call it a frothy temperature in the equity markets. So an equity margin account, this is where an investor can borrow money from a broker, take that money and buy more securities. So you can in fact leverage your investment portfolio. And you'll notice, watch the ratio. Remember, the shaded areas in this graph are recessions. Watch what happens as you pop into those recessions. You see going into the recession, this margin account balances grow. So investors are borrowing more money to invest. I don't want to say it's a perfect signal, but it's a signal telling us that many times when those numbers get exceptionally high, as you've seen, we hit those gray bars, we start to roll ourselves into recession. And as far back as we can make this chart go, which is pre-1950, we haven't seen margin balances anywhere near what we're seeing. Just anecdotally, I was pulled aside by a relative this weekend asking me what I knew about cryptocurrencies. Quick answer is almost nothing. Longer answer is I think we're finding some very dangerous signals about what's going on in some of these speculative markets. Here's another look at some of that. When we're hearing people who don't know anything about it looking to get involved in a SPAC, they can barely spell it, let alone define it. I start to get concerned about where we are. I mentioned I wanted to pull apart one particular commodity. I'm looking at the spot price for corn. Again, spot price, what is the open market price? Where could you go today and get delivery of a bushel of corn? The actual numbers aren't as relevant as the action on corn prices that are happening right now. A couple of things happening. We looked at commodities before where all prices are moving up. But corn in particular is spiking up. And remember, we don't just eat corn or feed it to cattle. We use corn in our fuel supply. It's not a new phenomena, but it's one that relatively new over the span of a few decades. And something we tend to forget when this particular commodity gets in short supply, it isn't just corn you buy on the side of the road, corn you feed that turns into beef prices, but it also is fuel supply. And there are some other extraneous factors happening in the fuel supply, as you probably read. Happy to report I didn't have to wait in line for gasoline this morning, but we don't live on the East Coast either. So that tends to take some of that out of our eye space, but we feel some definite upward pressure in fuel and in foods when we see corn going up. Now on to housing. Many stories you'll hear depending on where you live. The exacerbated process of buying a home now. People are buying homes based on pictures on the internet because you can get there faster. 20 offers per home that go in the first day. I have a little morning routine. I rode past a house the other day. First time I saw a sign for sale, I rode past it. The following day, accepted offer sign was out there. And it wasn't in the nicest neighborhood. It wasn't in the greatest shape, but the homes are going very quickly. Um, I'm going to look at something a little bit different. What we're looking at in this chart is our home prices to rent ratio. So we're looking at the difference of buying a home versus renting a home. And you see what's going on. Focus over to the 2019, 2020 into 2021, and you see how quickly that ratio is increasing. What that's telling us is home prices are increasing faster than rent prices are. So we don't have all housing costs moving up at the same rate. Rent prices tend to be bunching up a touch, but not to the extent that we're seeing in home prices. Why is that important? A number of things that we're talking about here are all part of the CPI, the Consumer Price Index basket of goods. When it comes to housing, the particular part of that basket, we don't use home prices. We use rental equivalents to home prices. So when you see this particular ratio spiking like it is, if you're a homeowner, that's your inflation. You feel that if you're trying to buy a new home, you're feeling that inflation, but the CPI number, where the official inflation number comes, isn't showing that. They're showing a rental equivalent to that. And that number, I was digging through last night, some of it, there is a 10-factor equation to determine what that number is. It defies logic. You need to have 3 PhDs, I think, to defy logic as much as you do there. But when we're looking at inflation, keep in mind, when I'm talking about inflation, I'm talking about what you're paying, not necessarily what the CPI is doing. And when it comes to CPI, this is the Fed statement. The word they've used is transitory. I wanted to make sure I looked it up because I thought I knew what that meant. And when I'm seeing what's happening, as we looked at the last couple of charts here, and I hear I'm not supposed to worry about it because this inflation is transitory. I thought perhaps they changed the meaning of the word, or maybe I've been using it wrong all my life. But no, in fact, it is not wrong. It is simply a non-permanent statement. How can I say this nicely? That makes 0 sense to say that these inflationary activity is happening and it's non-permanent and we're somehow going to work our way back. I think it requires a suspension of disbelief that I just don't own yet. To take a look at some of the frothiness, again, look at some of the price activity. One of our favorite ways of looking at equity prices is this this Shiller ratio, where in essence they take out some of the cyclical adjustments, the cyclically adjusted price to earnings ratio. As you say, when we look at price to earnings ratio of stocks, we say, yeah, it's a little high, but it's going to catch up as earnings catch up. We take that out of the equation, and we still see increases in our price to earnings ratios on stocks. So, we've got, as we talked about before, we got inflation cooking up. We've got unemployment still being very stubborn, and we've got equity ratios climbing through the roof. The picture I'm trying to paint to you right now is we're getting awfully tenuous in the financial space, whatever we want to define that. We've got a number of things that are working against us as far as holding rates down. And then we start to look at some of the headlines that are being pointed out. I mentioned Friday, added 266,000 jobs. I think we were looking for something like 4 to 5 times that number last Friday. All the while, stocks climbing, Dow hitting high records. Granted, this is May 7th. Today's May 12th. Things have changed a touch, as many of you may have noticed. But we've got these headlines that are coming at us from all over the place. Cryptocurrencies. Again, last night something happened, and the end of this headline is really interesting. What happens when the Fed stops raining money? What we're suggesting here, it's absolutely being driven by the helicopter money. The Fed throwing money at people who may or may not need it, money looking for someplace to go. Obviously, as an industry, we felt that significantly. But we're seeing all this money pumping up equity prices. We're seeing a lot of this money keeping people on the sideline. We've got actual inflation happening while the Fed is telling us we have 0 to worry about. And later on here, the Fed governor telling us it's too soon to talk about pulling the aid pullback. So The helicopters will continue to fly. Aid continues to come in. We continue pumping things up. Again, we don't know when this is going to end. We have a feeling it's going to end, but there are some really significant signs happening. And we were joking around about it. Talking about it, for those of us who remember the 70s, who were actually drawing breath in the 70s, when you think about what that looked like, where we finally realized you can have high unemployment and high inflation at the same time. There's still something that says you give up one to get the other, but we had to invent a new term, stagflation, for that. And it looks like we're kind of going through something like that again. We're seeing, as we mentioned, commodity prices popping up. We're seeing unemployment lines. We're seeing gas lines. We've got unrest in the Middle East. We're going down a road that, quite frankly, we've seen where this goes before, and there's a lot of concern about that, because when we went down that road in the 70s, it was very ugly. This came out just the other day, job openings reaching that record high level. So again, we've got an economy that wants to grow on its own, and there's friction coming from places still trying to put out the fire from before. So what we're saying, there's some concerns, there's some inflation concerns, but what is different this time is that a lot of what's happening that's causing the inflation and also causing people to do what they're doing is also keeping rates down to some degree. The Fed is experimenting with policies that we've just never seen how these things unwind, because we've never unwound anything before. So when we're saying that we're seeing signs of inflation, that's all well and good, but that doesn't mean that rates are necessarily going to go up. We have to be aware of what's going on. We have a very strong effort by people who print money as part of their job to keep rates low and keep that aid that we talked about in that previous headline. So with all of those things in mind, while we say that all of that's happening, what I would prefer to do, as you've heard from us many, many times, isn't so much take that and make an investment decision on it, but to do what Danny's going to talk about as coming up right here, and start to look at what the market is giving us and see how that fits in with our balance sheet. So with that, I'm going to turn over control. I'm going to remind Danny to unmute, because he tends to not do that, and have him pick up from here and go on.
How about that? Can you hear me? I hope so. All right, so thank you, Kevin. Now we can talk a little bit about what is out there in the market. And I'm going to tell you, it's still a pretty barren landscape, but as Kevin mentioned, let's look and see what is being presented in front of us and what makes the most sense out there. Typically, when we are looking for value in the markets, we generally are going to find that in the mortgage arena. That is typically where we're going to see some nice combinations of yields and returns and liquidity. And while I will say that mortgages have really made some strides over the past couple months, it has been chiefly a function of the prepayment models adjusting to the higher rates, slowing down prepayment levels that have brought them back into focus and at least have them presentable again. What we have on the screen right now is just part of our market overview page. We've got some mortgages up on the top here and some treasuries down on the bottom of the screen. Looking at the mortgages, the first bond we have up here is just a 10-year AM mortgage. It's a very short piece of paper, about a 3-year average life. And I can tell you the market remains pretty barren in that time frame. If we look at the 1 and 2 year, there is just very little to be offered out there that makes any sense at all. But here we've got a short mortgage that's given us about 69 basis points. So we're not going to be writing long letters home about that. But it is giving us some cash flow, some type of yield, and an expected return of 90 basis points over the course of the next year. When we look at the more standard mortgages that tend to be put in front of us, that would be the 15-year paper. We see we do have what I refer to now as triple-digit yields. We have that 1%, 112 really on both these. These levels were as of last Friday. So that certainly attracts some attention. When we look at our total return projections and the rates unchanged scenario over here on the right, we see expected returns of a 135. And again, given where we are in the short end, that sounds very attractive. The best mortgage performer as of late has been in the 20-year area. And what we see here is a 1.5 20-year. 153 is the yield that this little puppy was offered on Friday, with a 172 return in the rates unchanged scenario. So that gives us a little promise that there may be some value out there. But again, a lot of these returns are being generated from the fact that we now expect prepayment rates to slow down. To tell you, we haven't really seen it yet. Prepayment rates remained elevated. But given what's happened with yields in general, we would expect that the prepayment rate should slow. And with the premiums on this paper, that certainly is going to help us down the road. But before we get too excited about mortgages, if we look at the bottom of the screen, we see what has been our focal point really for the past couple months, and that is U.S. Treasury securities. Boring, but in this instant, it remains the oasis in the environment. What we're looking at here are yields that are certainly sharply lower than the mortgage backs when we're strictly looking at a yield basis. But those of you who follow us at Quantify, you know that we are very focused on total returns. We want to know, what are we looking at? What are the prospects of this investment? When we buy it, we put it in the portfolio. These returns are being calculated over the next year. But we want to see what happens not only if rates stay right where they are, but what happens if rates start to shift on us, if they drop back down to where they were back in August for the down 100 scenario. Or what if they continue to rise and go up 100, 200, 300 basis points? The total return is going to bring all that into focus. What we've been doing lately, especially, well, I say that, we've always done this, but we've really talked a lot more about it lately because of the reasons Kevin just poured through when we're looking at inflation numbers, is we're starting with the risk side. So if we want to take a look at the mortgage that is presenting the best apparent opportunity, and that's this 20-year right here, we see that in a rates up 300 scenario, it's going to drop 12.8. That's going to be the negative return of 12.8 in a rates up 300 scenario. If I look at something comparable on the Treasury side, we can see if we're looking between this July 2027, December 2027 Treasury, we've got about the same amount of risk embedded in this if it sits in the portfolio and rates start to rise on us. So what do these returns look like if rates stay right where they are? And what we see is a sharp pickup in the Treasury market. The mortgage is expected to yield a little over 170. We've got the Treasuries between a 219 and a 235 for the same amount of risk. If we look at what happens if rates go up 100, 200 basis points, again, we see the Treasuries with an advantage. They perform better in the rates up scenario than this mortgage does. And what happens if rates drop? The Treasury vastly outperforms the mortgage. It turns in between a 760 and an 814, while the mortgage is up 5%. So all the way across the board, whether rates stay the same, go down 100 basis points, go up 100, 200, 300 basis points, the returns on the Treasury dominate the performance versus the mortgage back. So that is certainly where our attention has been and where our activity has been over the past couple of months. Now, what's driving that? The shape of the yield curve has an awful lot to do with that, and a term that we use is called rolling down the curve. The area of the yield curve that is really the most attractive right now is the steepest part of the curve. And that is in that, going from 3 years to 4 years. So it's the 4, 5, 6 year area. We can see on the curve that we have very sharp appreciation, about 2 basis points a month appreciation, almost 1/4% a year in those time frames. So here we are getting paid to have this extension. And even though yields do continue to rise once we get past the 7 year, we can see from the curve this happens at a much slower rate. What's driving the returns is this effect called rolling down the curve, and we'll take a quick look at that. Essentially, what that curve roll down is going to do is create a second income stream for us. These are, again, treasuries going back to last Friday. And this first column here shows us what we're typically used to seeing. That is, what is the straight yield curve? And we see yields go from 11 basis points in the 2 year, up to 29 for the 3 year, all the way up to 119 for the 7 year. And, with these rising yields, we certainly see that, when we look in this 4 to 7 year, it certainly does have some appeal as these yields jump up. But what really has us focused on this is the total return. Now, remember, total return is simply taking this yield calculation, what's our income going to be, and then we add another component to it, and that is what's going to happen to the value of my security when I put it in the portfolio, when it's generating this annual income for me. What's happening to the value of that security? And what we can see right now is that when we look in that 4 to 7 year period, that is actually driving the return more than just the straight yield calc is. We're looking at a 4 year that's got a quoted yield of 52 basis points, having a total return of 128 basis points. So almost 3/4 of a point of that is coming from appreciation. Now let's see how that happens. The same day here, we've got the Treasury curve. We've got some selected maturities just going out quarterly. And we're just going to focus in on one to give an example here, and that's the Treasury 5/8 in November 2027. On this day, it was trading at a price of 96.872. And again, that was a yield of a 112. And if we look over to the right, under a rates unchanged scenario, we see a projected return of a 231. So how do we go from a 112 to a 231? And what we're going to see is just straight math. Here is the Bloomberg screen that shows us on May the 7th, when we're looking at this, that dollar price of 96.872 does indeed present a yield of a 112. Now we know this has got a 5/8 coupon. So we know we're going to get, for $1 million investment, we're going to get that $6,250 in coupon income come to us. But we're also going to get some straight appreciation. And in this case, this would be some accretion. We're buying at a discount here. So if I fast forward to May 7th of 2022, and I plug in my book yield of a 112, I see that my price is now 97.336. So that's going to be very close to what our book value will be on May 7th of 2022. So to figure our yield, we've got our $6,250 in coupon income. And we see that the value of our security, when we put in this accretion, goes from $971,000 to $976,000. So we've got actually a total of about $4,600 in appreciation there in book value. We add that to our $6,250 in coupon income and get $10,850 in total income. And for an investment of about $969,000, that equates to a yield of a 112. So that's where the yield component comes from. But how can we sit there and say our total return is going to climb so much? Why are we going to say that it's going to be worth more than just this coupon income and accretion? And here's the answer. If we go back, and let's see if I can go back here. Look at that same chart. We're going to be looking at a 1 year horizon. So our November 2027, a year from now, if rates don't change, it's going to be in a maturity that is currently yielding 88 basis points. So if we are looking at the total return and we want to say that in our 1-year horizon, rates are unchanged, the value of this security is going to gravitate to that 88 basis point yield. That would represent rates unchanged for that maturity. You can see that now our market value is up to just a little under 98 5/8, 98.607. Our market value has gone up to 988,000 and the rates unchanged. So we picked up 10,850 in total income using the yield component. But what we see, if rates don't change, we are adding another $12,700 in income. So if we combine those two, that is where these figures are coming. We don't need a change in rates to see that kind of appreciation. So there's two things driving that. There's the yield curve itself. We saw that real steep portion of the curve. And and then we're looking at, in a rates unchanged environment, as we slide down that curve, we are going to naturally get that price appreciation. We looked at this under the rates unchanged to see that big return, but keep in mind, if we're getting about a 25 basis point advantage in that scenario, that's going to work across all these different rate scenarios. If rates go up 100 basis points, to us, it's going to feel like about a 75 basis point increase for the same security in that scenario as we slide down the curve. So it is a real advantage no matter what scenario we look at. And that is really what has brought us to that gravitation to it. When we look across the different rate scenarios and we look and see what are the returns, what we are typically seeing these days is effectively a domination of the Treasury securities. What's really driving this is the fact that the cash flows aren't going to change. We don't have any convexity in this. We know we're going to get our coupon every 6 months, and we know exactly when our principal's coming back. So with the mortgages, we've got some convexity. When rates go up, we know they're going to extend. They're going to be a little bit longer. That's not ideal for us. It's the opposite of what we want to have happen. What it does is add a little additional risk to the equation. And if we buy the security and we're right and rates drop, what we know, what we certainly have just witnessed and have witnessed in the past, is a rapid acceleration of prepayments, which is not only going to affect us in terms of yield of that money coming back, the premium coming back faster, but it is also going to shorten the duration of our security, which will also affect our market value. So right now, that oasis out in the investment world continues to be treasuries. We are constantly on the lookout for agencies. Any security with fixed cash flows is going to work. It's that 4 to 7 year time frame that really makes the most sense right now. And I know I had to blow through this very quickly, so if anybody would like to walk through it a little bit slower or have any questions, please feel free to give us a call, and we'd be happy to talk to you about it. So I think I'm in. I think that was the extent of what we're going to cover today. I apologize, we went a little bit over. But again, if you have any questions or you would just like to talk a little bit more about this or total return in general, please give us a call. We'll be happy to help. Thanks for tuning in.